Thank you, Minister Jorge Quiroz, for sharing with us your vision on Chile's fiscal policy, growth agenda, and global positioning. Good afternoon. My name is Isabel Margarita Bravo, Director of Invest Chile Day, and it is a great privilege to introduce our next speaker, Mrs. Rosanna Costa, Governor of the Central Bank of Chile. Governor Costa holds a bachelor degree in business administration with a minor in economics from Pontificia Universidad Católica de Chile. Throughout her distinguished career, she has played a leading role in Chile's economic policy making and institutional development. Today, as governor of the Central Bank of Chile, she leads one of the most respected institutions in Latin America, recognized internationally for its independence, technical excellence, and credibility. Under her leadership, the central bank continues to play a critical role in safeguarding monetary stability, financial resilience, and confidence in Chile's economy. Please join me in welcoming Governor Mrs. Rosanna Costa.
Good afternoon. Thank you for this presentation, Isabel Margarita. Once again here in New York, I would like to thank very much Invest for organizing this meeting year by year, good years, bad years, every year. Chile Day represents an important effort which allows to convey Chile's reality, our achievements, our ongoing challenges, and our experience as a small, open economy. This initiative has been in place since mid-2000s, and over time has brought together Chilean authorities and a broad audience interested in gaining a deeper understanding of our country and its strengths as an investment destination. I am confident that this new edition will be fruitful for all the participants. In the next couple of minutes, I will make a brief review of the macroeconomic scenario shaped by the impacts of the conflict in the Middle East, and then I will briefly refer to some aspect of our short-term payments agenda. Without further preliminaries, let me move to the contents. First, macroeconomic scenario since the March monetary policy report. As I mentioned, the macroeconomic scenario of the past 2 months has been strongly influenced by the conflict of the Middle East and its impacts. The conflict represents a significant shock to both global and the Chilean economy. A relevant share of globally traded oil and other raw material passes through the Strait of Hormuz. Its closure has had a significant effect on prices with fluctuations that respond to the developments of the conflict and announcement about the advances and setbacks in the effort to end it. As the time passes, the assessment of its consequences becomes more complex. A relevant factor is how long it will take for the region's supply of raw materials to normalize, which is not evident even under the scenario of an early resolution of the conflict. It will be important to monitor factors such as the time it takes to restore normal maritime flows, the magnitude of the damage to productive capacity, and the potential effects on risk premiums and demand for inventories. It should also not to be overlooked that as the conflict drags on, we approach a point at which oil reserves are depleted, and therefore this mitigator dissipates. This will exert additional pressure on oil prices, which will affect more severely importing countries whose productive matrix is more dependent on oil, and those with less fiscal spending space to cushion its impact. In any case, for now, the future price curves for oil and other commodities point to a decline in the short term. However, the levels to which they would return are above those expected at the end of February. At the same time, the response of global financial market has been less adverse than might be expected in light of the prevailing risks. Compared with the onset of the conflict, global stock markets have improved and the dollar has appreciated slightly while long-term interest rates have risen. Certainly, this behavior has shown volatility, closely tracking developments in the conflict, which has been quite visible this week. You can see in the picture I'm showing there, on the left side, you have the evolution that the curve for oil prices has over time. The red line is the one we use in the forecast of the monetary policy report. The other lines is how day by day are moving in this with a very similar picture, but going up and down every time over the red line we use in the forecast. The pink line was what was happening before the conflict. In the middle of the picture you have in front of you, we have the accumulated change for stock markets and for DXY. And on the right side, you can see that how was the evolution of the 10-year US Treasury yield. So the reaction of the market was very surprising because in comparison with the size of the event we are living. In this more uncertain context, the monetary authorities in many economies have adopted what could be described as a wait-and-see approach, highlighting the need to gather further information on the impact of the conflict on the medium-term inflationary outlook. For a central bank like Chile's, which has a strong commitment to a 2-year inflation target, the outlook is not simple to analyze. On the one hand, it cannot be ruled out that this is only a transitory shock to inflation and that after a few quarters its impact on the economy will be diluted. This is the central scenario of the March Monetary Policy Report that considers future oil prices at that time. In that scenario, monetary policy rate remains at its current level for an extended period. However, scenarios where the monetary policy rate follows a different path cannot be ruled out, either depending on how medium-term inflationary pressures evolve. At this point, it is important to carefully analyze the price formation process, even more so considering that during the last 5 years, we have faced different inflationary shocks that have diverged us from the target. Throughout that period, the action and credibility of monetary policy have played a relevant role in keeping inflation expectation anchored. Recent experience has shown us how complex it is for the economy, and especially for households, to cope with episodes in which inflation is far from its normal level. Achieving the inflation target of 3% in the 2-year term is a duty of the central bank, and we will do what is necessary to accomplish it. We are clear about the importance of meeting the target for the country's macroeconomic stability and the ability to develop businesses. More importantly, it is essential to safeguard the well-being of families, particularly the most vulnerable. In any case, it is important to mention that this shock found us with a balanced economy, with inflation below the target, anchored inflation expectation, and a monetary policy rate within the neutral range. We assess that this gives us some room for prudent action. Let me now briefly refer to the new information that we have accumulated in recent weeks. This morning, we learned the CPI data for April, whose annual variation increased to 4% from 2.4% in February. This is a significant rise in inflation in a couple of months, which responds in large part to the direct impact of higher fuel prices on the CPI basket. You can see in the next picture the evolution of headline inflation, volatile inflation, the red line, and core inflation, or non-volatile components of inflation in the CPI baskets. As for expectations, inflation insurance prior to today's inflation data pointed to inflation being between 4.5 and 5% 1 year ahead. Meanwhile, 2 years ahead inflation expectation from surveys of experts remain at or around 3%. On the right side, you have inflation insurance. On the right side, you have 2-year inflation expectation using surveys from financial traders and from economists. And you can perceive that inflation from economists 2 years ahead is anchored on 3%, while 1 year ahead, you perceive that inflation insurance goes up. For its part, IMASEC data anticipate that the performance of GDP in the first quarter was lower than expected in the monetary policy report. This was mainly affected by supply factor linked to natural resource sectors, which also affected the behavior of manufacturing and some services. In any case, the figures from the national accounts that we will know in a few more days will allow us to carry out a more comprehensive analysis of these trends. And here you have different sectors, how was the evolution that IMASEC is pointing to all of them during the last months. You can perceive that the services sector is continuously with a trend on the upside, and you can perceive some supply side sectors weaker on the first part of this year. On the consumption side, high-frequency indicators suggest that in the first quarter, household spending would have evolved in line with expectations. In the labor market, the unemployment rate has increased in the most recent data, and job creation remains sluggish. On the investment front, high-frequency indicators anticipate that in the first quarter, investment in machinery and equipment would have been lower than expected. However, the survey of projects on the Capital Goods Corporation had a significant increase in the amounts foreseen for the period 2025 to 2029, which improves its prospects. Unemployment rate on the left side, and the evolution of total investment on the right side. Investment captured by the Capital Goods Corporation mentioned before by the minister. All of these unfold in a context in which business confidence and more markedly those of consumers have deteriorated recently, coinciding with the external scenario. Business expectation showed by the IMSE in our country, that is expectation from firms, and consumer expectation on the right side. In short, as we pointed out at our last monetary policy meeting, we have little new information with respect to the March monetary policy report. So the challenge is to continue gathering incoming data and carefully evaluate the scenarios. Against this backdrop, the future evolution of the monetary policy rate will be evaluated on a meeting-by-meeting basis as events develop. Let me now refer briefly to our short-term payments agenda. Principles governing the central bank and its vision on digital payments. Chile has an advanced digital payment system that has undergone significant changes and developments in recent years. The central bank, as a regulator of payment system and issuers and acquirers of payment cards, has played a key role being a catalyst for these advances. The evolution of payment methods in Chile has required a permanent adaptation of the regulation of payment cards, issuers and acquirers, allowing the diversity of industry players to be expanded, as well as increasing the coverage of merchant networks added to these payment systems. Although less visible, these developments are also grounded in the ongoing modernization of the network of financial market infrastructures. This included the regulation of retail payment clearinghouses, which continues to be implemented. The bank's participation in these processes is natural, given its legal mandate to ensure the normal functioning of internal and external payments and the attribution conferred on it by the constitutional organic law in this area. Historically, the implementation of this mandate has been based explicitly or implicitly on three fundamental principles: security, efficiency, and access. These principles are permanent as business models and technologies may change, but not the essential economic and financial function of payment systems. As I mentioned, in recent years, effort has been focused on financial market infrastructures and on the issuance and acquiring of payment cards. This year, our agenda focuses on two priorities: strengthening the instant payment system, in particular its extension to P2B or person-to-business payments, and the development of a regulatory framework for stablecoins. I will now refer of these matters. Chile was a global pioneer in enabling interbank transfer with intermediate availability of funds in 2008. As a result of these early developments, we have a privately operated instant payment system with high degrees of interoperability for electronic fund transfers, EFTs. This system is subject to the central bank's regulation for retail payment clearinghouses, which sets standards for the acceptance, clearing, and settlement of EFTs. This regulatory framework has been key to sustaining confidence in the system and mitigating operational and financial risks. Despite the attributes of the EFT payment system, its widespread use, the challenges remains to improve the experiences for person-to-person and business-to-business payments, and to expand its use occasional person-to-person to more efficient P2B payment. Currently, 76% of interbank ETFs correspond to payment between persons, with only 10% used for payments from persons to companies. The development of payments to business through ETF has not occurred naturally, suggesting the existence of industry coordination problems or insufficient economic incentives to develop it. The central bank has consistently underscored the importance of making progress in this area. Failing to do so, on the one hand, means that the participants of the system, individuals, merchants, account providers, and payment services, lack access to a digital payment alternative that is available and rapidly developing in several countries. On the other hand, it remains concentration in a limited set of instruments. Developing account-to-account payment from person to businesses would allow for a parallel payment road, strengthening the resilience of the system against possible interruption in card payments. The central bank's vision is to move toward a system with multiple payment channels where different instruments coexist and compete, allowing users to choose according to their preference, costs, and conditions. While initiatives in this direction exist, they have been promoted by individual actors and lack an open access framework for all issuers, acquirers, and similar entities. We consider it essential to encourage the greatest possible interoperability, minimizing the fragmentation of payments account to account. To move forward, we are studying options to promote the development of interoperable instant payment for merchants using the current legal attributions. This may require encouraging the development of interoperable alliances schemes, such as QR codes or others, that facilitate payments with EFT in merchants and make them an effective and efficient alternative. In this process, we develop the development of a new stage of regulation of retail payments clearing houses will play an important role. In this context, we have initiated a structured process of dialogue with actors in the payments industry. This includes meetings to gather their views on the aspect that could be hindering the development of instant payment interoperable to commerce, as well as on the measures that could best contribute to the development of these means of payment. Several instances have already been held, and they will continue going forward. Our goal is to publish in consultation during the third quarter of this year the necessary adjustment to different bank regulation that will allow us to advance in the strengthening of instant payments. In parallel, and in compliance with the mandate established in the FinTech law, we will also propose the rules applicable to payment initiators that, in their operations, temporarily hold resources from the public. It is important to highlight that this agenda does not seek to replace card payments, which account for more than 70% of household consumption, particularly debit payments. The objective is to expand the range of digital means, particularly the objective is to expand the range of digital means of payments available, incorporating modalities that already exist in other countries with different levels of acceptance. The development of this alternative requires reviewing and defining key regulatory aspects and harmonizing them with recent developments for retail payment clearing houses. As this modality consolidates, we will evaluate that additional adjustment may be required to the large and retail payment infrastructures that support it in order to ensure their smooth functioning and operational and financial resilience. Once we have framework of broad agreement that enables the development of this alternative means of payment, we will closely follow its development. We understand that the advanced starting point of our system, with a high penetration of payment cards, moderates expectation of a rapid and large-scale adoption of as seen in other countries, such as Brazil or India. However, we believe there is room for a relevant development of this option in a limited time frame, if there is an adequate user experience and interoperability. If we do not observe such progress, we will carefully analyze its underlying causes and the options available to address them. It should be noted that this agenda was built on previous advances made by the bank in the regulation and infrastructure of payments. As mentioned earlier, strengthening instant payment is a step that we consider essential, since it will enhance the robustness of the payment system and expand options available to people and businesses. Stablecoins. The second regulatory priority for the remainder of the year is the regulation of stablecoins within the framework of the powers established by the FinTech law. Broadly speaking, a stablecoin is a digital asset that promises to maintain a stable value against a reference currency. Thus, when a unit of stablecoin is created, the issuer assumes the obligation to always convert it into the reference currency at a fixed value. To fulfill this obligation, the issuer backs the stablecoins with a basket of assets. In its most basic use, a stablecoin can function as a means of payment. Its adoption will depend on the alternative available in each country, potentially being of greater interest in countries that do not have immediate payment systems or where these are less efficient and secure. One of the most widely developed applications is its use in cross-border remittances. In some countries, they are also used as a store of value in dollars. In addition, stablecoins are seen as a bridge between traditional money and cryptocurrencies, and increasingly as a means of settlement for transaction of tokenized assets on distributed ledger platforms. In some cases, they are also traded and treated as financial assets. This diversity of uses implies relevant regulatory challenges. Among them, the need to adequately protect the users who entrust their resources to the stablecoins issuers by establishing stability and liquidity requirements for the backing assets, considering their possible implication for financial intermediation and the transmission of monetary policy. There are also concerns about the linkage between the demand for stablecoins and the assets that support them, including bank deposit, which could amplify risk to the financial system if their use were to grow significantly. Moreover, unlike the other areas, such as instant payments, international experience in stablecoins regulation is still incipient, which adds relevant challenges into its regulatory design. Considering all these factors, the bank has adopted a gradual regulatory approach. One of the first steps is to reduce the information gap and deepen the understanding of the different dimensions at play. To this end, we started this year by requesting information from local cryptocurrencies platforms that trade stablecoins, and meetings have been held with market agents, academics, other central banks, and regulators. This work will continue in the coming months, and we are going to issue the first mention about the regulation at the end of this year. I think that the central bank is committed with inflation, with a good and strong system of payment, giving the economy a platform for growth. Thank you very much.